Hey everyone, Graham Stephan here. Today we're diving into the world of ETFs, specifically GPIQ and JEPQ. These aren't your average ETFs. They're focused on tech stocks, which are known for growth. But here's the twist. They also aim to provide you with a steady stream of income. Sounds good, right? Let's break it down and see which one might be right for you. Before we dive into the details, let's set the stage. What exactly are GPIQ and JEPQ, and why are so many investors talking about them right now? If you've ever wondered how to earn steady income from the stock market without picking individual stocks, these two funds might be just what you're looking for. In this chapter, we'll break down what makes them unique, how they work, and why they've become so popular among both new and experienced investors. Both GPIQ and JEPQ are what's known as exchange-traded funds, or ETFs for short. Imagine an ETF as a basket that holds dozens, sometimes even hundreds of different stocks or other assets. Instead of buying each stock individually, you can buy a share of the ETF and instantly own a slice of everything inside that basket. The best part? You can buy and sell ETF shares on the stock market just like you would with any regular company stock, making them super flexible and easy to trade. Let's start with GPIQ. Its full name is the Global X Nasdaq 100 Covered Call ETF, and it made its debut in December 2020. GPIQ is designed to track the performance of the Nasdaq 100, which is an index made up of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. This means you're getting exposure to some of the world's most innovative and fastest-growing tech giants. Think Apple, Microsoft, Amazon, and Google, all in one fund. GPIQ is especially appealing to investors who want to tap into the growth potential of the tech sector. But with a twist, it also aims to generate extra income through a special options strategy. Now let's talk about JEPQ, which stands for the JP Morgan Equity Premium Income ETF. JEPQ actually launched a few months earlier in May 2020, and it's managed by one of the most respected names in finance, JP Morgan. Unlike GPIQ, JEPQ focuses on the S&P 500, which is a broader index that includes 500 of the largest companies in the United States, spanning all kinds of industries. The goal of JEPQ is to provide investors with a steady stream of income, but with less risk than simply owning the entire S&P 500 outright. It's a great option for people who want to balance growth with a bit more stability and regular cash flow. What really sets both GPIQ and JEPQ apart from traditional ETFs is their use of a strategy called covered calls. In simple terms, this means the fund managers sell options contracts on the stocks they own in the ETF. By doing this, they collect extra income known as premiums, which gets passed on to investors in the form of higher distributions. It's a way to squeeze a little more cash out of the stocks in the fund, especially during times when the market isn't soaring. We'll dig deeper into how covered calls work and what that means for your returns in the next chapter, but for now, just know that this strategy is a big reason why these funds are so attractive to income-focused investors. So here's the bottom line. Both GPIQ and JEPQ are designed for people who want the best of both worlds, steady income and the potential for long-term growth. Whether you're saving for retirement, looking to supplement your paycheck, or just want to make your money work a little harder, these ETFs offer a unique approach that's worth considering. In the next chapters, we'll break down their strategies, risks, and performance, so you can decide if they're the right fit for your portfolio. Now let's talk about a powerful strategy that can help you boost your income from your investments: covered calls. If you've ever wondered how some investors seem to generate extra cash flow from stocks they already own, this is one of the most popular ways to do it. Covered calls are a favorite among both beginners and seasoned investors because they can provide steady, reliable income, even in markets that aren't soaring. Don't worry if the term sounds intimidating. Covered calls are actually much simpler than they appear at first glance. Think of it as a way to get paid for owning stocks you already believe in. You don't need to be a financial expert or a Wall Street pro to take advantage of this strategy. In fact, with a little bit of learning, anyone can start using covered calls to enhance their investment returns. Let's break it down with a simple example. Imagine you own a stock. Maybe it's a company you like, or perhaps it's part of a diversified portfolio. You're already holding on to it, hoping it will go up in value over time. But what if you could earn extra money from that stock, even if it just stays flat or moves only a little? That's where covered calls come in. A covered call is like making a deal with another investor. You agree to sell them your stock at a specific price, called the strike price, by a certain date. In exchange, they pay you a fee, known as a premium, for this right. It's a bit like renting out your stock for a while and getting paid for it, whether or not they actually end up buying it. The best part? You get this premium up front and it's yours to keep, no matter what happens next. This extra income can add up over time, especially if you repeat the process month after month. It's a smart way to make your investments work harder for you, generating cash flow that you can reinvest, spend, or save. If the stock price rises above the strike price, the buyer will likely exercise their right to buy your stock at that agreed-upon price. You'll sell your shares, but you'll also keep the premium you received. This means you make a profit from both the sale of your stock and the premium. It's a win-win if you were planning to sell at that price anyway. But what if the stock price stays below the strike price? In that case, the buyer won't exercise their option, and you keep both your stock and the premium. You can then repeat the process, selling another covered call and collecting more income. Over time, this can significantly boost your returns, especially in sideways or slightly rising markets. Now let's look at how this strategy is used in real-world investment products. Here's the difference between two popular ETFs, GPIQ and JEPQ. JEPQ uses something called equity-linked notes, or ELNs, to implement its covered call strategy. These are special contracts that help the fund generate income, and the management team actively selects which stocks to include and when to write calls. This hands-on approach means the team is constantly analyzing the market, aiming to maximize returns for investors. GPIQ, on the other hand, takes a different approach. Instead of relying on a team to make active decisions, it follows a strict set of rules. This rules-based strategy doesn't try to outsmart the market or make predictions about which stocks will perform best. Instead, it applies the same process consistently, which can help reduce emotional decision-making and keep things simple for investors. The result? GPIQ offers a more transparent and hands-off experience. You always know what to expect, and you don't have to worry about sudden changes in strategy. Whether you prefer the active management style of JEPQ or the rules-based simplicity of GPIQ, understanding covered calls can help you make smarter choices and potentially boost your investment income over time. Let's take a closer look at what's actually inside these two ETFs. When you invest in an ETF, you're essentially buying a basket of different stocks all bundled together. But not all baskets are created equal. The specific stocks inside each ETF can make a big difference in how your investment performs, how risky it is, and even how much you might pay in fees. So, what exactly are you getting when you choose GPIQ or JEPQ? As I mentioned, GPIQ tracks the NASDAQ 100, which means it's designed to mirror the performance of the 100 largest non-financial companies listed on the NASDAQ exchange. So you'll find a lot of familiar names in this ETF. Think Apple, Microsoft, Amazon, Google, Meta, and Tesla. These are some of the biggest and most influential tech companies in the world, and they make up a significant portion of GPIQ's holdings. If you're looking for exposure to the giants of the tech world, GPIQ is packed with them. On the other hand, JEPQ is more diversified. It holds stocks from the S&P 500, which is a much broader index that includes companies from a wide range of industries: technology, healthcare, consumer goods, energy, and more. This means JEPQ isn't just about tech. It's about capturing the performance of the overall U.S. stock market. But even though JEPQ is more diversified, it still has a big chunk of tech stocks. That's because technology companies make up a large part of the S&P 500 these days. So you're still getting plenty of exposure to tech, but with a broader mix of other sectors as well. The key difference between these two ETFs comes down to how they're managed. JEPQ's management team actively picks and chooses which stocks to include and how much of each to hold. They're constantly analyzing the market, looking for opportunities and making adjustments to the portfolio. This active management can potentially help the fund respond to market changes, but it also means higher management fees. Meanwhile, GPIQ is a passively managed fund. It simply follows the NASDAQ 100 index, buying and holding the same stocks in the same proportions as the index itself. There's no team making day-to-day decisions about which stocks to buy or sell. This approach usually means lower fees, but it also means you're locked into whatever the index is doing. Think of it like this. JEPQ is like having a personal chef who creates a custom menu just for you, adjusting the ingredients and recipes based on what's fresh, what's trending, and your personal tastes. The chef can swap out dishes, add new flavors, and make sure your meal is always tailored to your preferences. On the other hand, GPIQ is like going to a buffet with a set menu of popular dishes. You know exactly what you're going to get, and you can fill your plate with as much or as little of each item as you like, but the selection doesn't change much. Both approaches have their pros and cons, and the right choice depends on your personal investment goals and how much control you want over your portfolio. Okay, let's talk about everyone's favorite part, income. Both GPIQ and JEPQ aim to pay you monthly income. Historically, JEPQ has had a slightly higher yield, meaning it pays out more relative to its price. However, remember that yields can change. They depend on factors like interest rates and how well the stock market is doing. Don't just chase the highest yield, look at the bigger picture. Now here's something crucial that honestly a lot of people overlook: fees. Every ETF charges a fee called an expense ratio. GPIQ's expense ratio is around 0.68%, while JEPQ's is a bit higher at 0.75%. It might seem small, but those fees really add up over time. Remember, you're not just losing the fee itself, but also the potential growth that money could have made. Let's be real. Investing always comes with risk. Both GPIQ and JEPQ aim to provide some downside protection, meaning they try to cushion your portfolio when the market takes a dip. However, their management styles affect how they handle risk. JEPQ, with its active management, has more flexibility to adapt to changing market conditions. GPIQ, being more rules-based, might not be as nimble. So, which one should you choose? If you're looking for a more hands-off approach and believe in the long-term potential of tech stocks, GPIQ might be a good fit. If you prefer a more active management style and want a slightly higher potential income stream, JEPQ could be your pick. Ultimately, the best choice depends on your individual goals, risk tolerance, and time horizon. Do your research, understand the risks, and invest accordingly. Here's a thought. You don't have to choose just one. You could consider adding both GPIQ and JEPQ to your portfolio. This way, you get exposure to both the NASDAQ 100 and the S&P 500, along with the benefits of both active and passive management. Remember, diversification is key. By spreading your investments across different assets and strategies, you can potentially reduce risk and enhance returns.